Okay, the silver market in early 2026 has been just an absolute roller coaster, right? And if you're trying to make sense of it all, it really comes down to one critical word: leverage. So, in this explainer, we're going to break down exactly what that means and how it applies to some of the most talked about silver stocks out there right now.
It all kicked off with this number, a stunning, honestly, an unprecedented all-time high of $121 an ounce. Now, this wasn't just some new record. It was a market-shaking event that put silver on every single investor's radar and, created this massive amount of buzz.
But you know how it goes. What goes screaming up can definitely pull back. After that huge peak, the price has kind of settled into this $80 to $88 range. And this volatility has left a lot of people scratching their heads, wondering, what's the right way to even think about this market now? Is this a dip to buy, or is it a sign of some serious instability? Well, to answer that, we really need to get a handle on the leverage game. I'm telling you, this is the single most important concept for figuring out why some silver stocks are absolutely flying while others are just not. It's the key to navigating this whole new era for the metal. So, what is leverage? In this context, it's actually pretty simple. It's basically a measure of sensitivity. All it does is tell you how much a company's stock price is expected to move for every 1% move in the actual price of silver. You got to think of it as a multiplier effect. Let me show you how it works in practice. So if the price of silver itself moves up, say 1%, a highly leveraged stock might jump 3, 5, or maybe even 10%. But, and this is a big but, it's a double-edged sword. That exact same leverage applies on the way down, and not all leverage is created equal. So let's break it down into three main categories. Okay, first up, we have the purists. These are the companies that are, for all intents and purposes, pure play silver companies. Their fortunes are tied directly, and I mean immediately, to the spot price of silver. So the thing you have to remember about these companies is that they get the vast, vast majority of their revenue from silver. There isn't a lot of gold or copper or zinc in the mix to dilute the effect. And what that means is, when silver prices rise, their profits don't just increase, they can absolutely explode. This gives them the most direct, unfiltered exposure you can find. A classic example here is First Majestic Silver. It's often called the purest play out of all the major producers. Now, what's really cool about these guys is that they don't just mine silver. They've gone a step further and actually operate their own mint to sell physical bullion directly to retail investors. That gives them another whole layer of connection to the market. Then you've got Hecla Mining, the biggest silver producer in the United States. Operating in safe jurisdictions is a huge plus. But just look at that performance, a nearly 300% surge during the big metals rally. That just shows you how incredibly sensitive, how leveraged this stock is to a rising price environment. All right, let's move on to our next category and see how this all builds. These are the giants. We're talking about the big, established producers that offer a totally different kind of exposure to the silver market. So what makes these guys tick? Well, they're typically known for their high margin operations and, very importantly, they're often diversified into other metals like gold. And that diversification, it can smooth out some of the wild volatility, which is why they're often seen as a, quote, safer way to invest in the sector. Pan American Silver is the textbook example here. After it acquired Mag Silver, it became an absolute behemoth. And while it produces a lot of gold, its total silver equivalent production is among the highest in the world. That makes it a really powerful, if maybe less volatile way to get exposure. Now, this is fascinating because it shows a completely different business model. Meet Wheaton Precious Metals, a streamer. So think about it. While a traditional miner has to deal with rising costs for everything, fuel, labor, you name it, Wheaton doesn't. They give financing to miners upfront, and in exchange, they get the right to buy silver at a fixed, super low cost for years to come. This makes them almost immune to inflation at the mines, giving them incredible leverage to the silver price itself. And finally, this is where things get really wild. Our third category, the moonshots. If the giants are all about safety, these companies are all about raw, explosive potential. This is the highest risk, highest reward part of the whole market. So these companies aren't actually producing any silver yet. They're in the business of finding and developing the mines of tomorrow. And because their entire value is based on future potential, their stock prices can react so violently to moves in the silver price. This offers the potential for truly magnified gains, and you have to remember this, also magnified losses.
Vizsla Silver is a perfect case study. They've made one of the highest grade silver discoveries in Mexico in recent memory. And as they get closer to actually turning the mine on this year, every single dollar increase in the price of silver has a massive impact on their project's projected value. Now, Abra Silver down in Argentina offers a different kind of leverage. Their project is huge, but it's a lower grade. The key here is the price threshold. Once silver stays above a certain level, let's call it $50 an ounce, the project's economics just flip a switch, and it becomes exponentially more profitable. And let's look at Dolly Varden, up in British Columbia's famous Golden Triangle. The key detail here is that they are fully funded for a huge drilling program this year. Now, what does that mean? It means they can go on this massive treasure hunt for a game-changing discovery without having to come back to the market for more money, which de-risks the whole exploration story in a big way. So let's just put it all together with a quick comparison. You've got First Majestic, which has leverage from its purity and those direct retail sales. Hecla has it from its low-cost U.S. production. Vizsla's leverage comes from its incredible high-grade discovery that's right on the cusp of production. And Wheaton gets its leverage from a totally different angle, its fixed costs and immunity to inflation. 4 companies, 4 very different kinds of leverage. And this all brings us to the final, crucial question you really should be asking yourself. In a market as volatile and as uncertain as this one, which form of leverage is the most compelling to you? Is it the direct, raw exposure of purity, the stability of safety, or the explosive upside of potential? The answer is really going to shape how you see this whole new era for silver.